So the Philippines is largely unknown as a potential tax haven, but depending on your circumstances and if you are non-Filipino, then there can be some serious tax advantages to at least moving there or spending significant time there. And so, especially in light of the fact that many other countries are starting to tighten up their tax rules and become less tax friendly, I can imagine that perhaps over the next few years the Philippines will start to become more attractive to a lot of people. So in this video I'm just going to take you through in what circumstances can you get a very friendly tax situation in the Philippines, and what kind of things you should be considering about if you are thinking about moving there or spending more time there. So if you're new to this channel, I'm Andy. I've been an international tax advisor since 2014, chartered accountant since 2018, and I take you through the complex world of international tax. So what is the Filipino tax regime? Well, first off, they do have a residency basis of taxation, broadly meaning that if you spend more than 180 days in the Philippines in the year, then you will be a tax resident of the Philippines. But the second stage of this, and this is quite unique to the Philippines, is that what you're taxed on depends on what your citizenship is. So if you're a tax resident and you're a citizen of the Philippines, then you're actually taxable on your worldwide income. Whereas if you're a tax resident but you're a non-Filipino citizen, then you're actually only taxed on your Filipino sourced income. So for the majority of people that are actually planning on moving to the Philippines that don't have Filipino citizenship, in this case you basically are going to have a lot of possibilities for a kind of tax-free lifestyle so long as you're not sourcing income from the Philippines. So particularly people that have investments abroad, they have lots of income streams abroad, potentially rental property from abroad, it could be pensions, anything to that nature is going to be clearly non-Filipino sourced income and therefore non-taxable. So this can actually be a very good setup depending on your circumstances, and fairly unique situation. Be a tax resident there, but only pay taxes on what is ever sourced from that country. And there's no worries about remittances here. So I know Thailand has a little bit of a remittance-based taxation system where sometimes bringing money into the country in certain circumstances can be taxable. Well, there's no worries there. It just doesn't matter as long as the money was not sourced from the Philippines, then it won't be taxable in the Philippines. So the next part really is therefore to understand, well, what does source in the Philippines mean? But because I think it's quite simple when it comes to anything that's paid from abroad, whether it's investments, capital gains from abroad, all of that is clearly foreign sourced. But then you've got to be careful when it comes to, let's say you've got a business, and if you're working on that business in the Philippines full time, this is something that could kind of be in a grey area, but probably ticks the box of actually, yeah, you do have some Filipino sourced income. So a common myth that does get recommended when you have a country which taxes you only on locally sourced income is, well, set up a US LLC or a foreign limited company and just work through that and just pay yourself from that, because then that's going to be foreign sourced income. Now, a lot of the time that doesn't actually work. Most countries which have this kind of territorial system will still see that, well, if you're doing the majority of the work for the business, you're still generating the profits whilst you're in this country, Philippines being no exception. They can still say, well, this isn't really foreign sourced income, you are basically sourcing it from our country whilst you're here, and we can still tax you on this accordingly. So it is quite important just to understand that just having a foreign company does not automatically mean that you don't have local sourced income. In many cases people can fall into that trap. So then a question that does get asked is, well, I've got a foreign company, a US LLC, a UK limited company, and I'm working on it full time in the Philippines. How can the Philippines actually know? How will they see what's happening in this foreign company? It seems unlikely. And it is a fair question. The Filipino tax authorities are very poorly resourced. Tax enforcement is generally known to be quite lax because they have a very informal economy. A lot of transactions just being done through cash. Their tax enforcement just is pretty poor on the whole. And particularly even with foreigners, they know a lot of people are taking the advantage of the foreign sourced income benefits, and so they know, in general, they're not going to be chasing a lot of foreigners either for taxes. But in spite of all that, I would say that, and I say this to every client, relying on lack of enforcement is not a tax strategy. Basically, the problem here is that whether enforcement is high or low, you're always going to be at the whim of a tax officer, of the law. It puts you in a vulnerable position from the start, and it's just not something that you should really be using as the kind of basis for your strategy, because you just never know, and especially in a country like the Philippines that is known to have high levels of corruption. If you get on the wrong side of someone in the Philippines, if you just get randomly asked on a day that you're potentially renewing a visa or something, you just never know what could happen. I personally wouldn't want to spend time in a Filipino jail cell, and you can never really be sure about what the consequences of evading the law in a country like the Philippines could end up in. And there's enough advantages of being in the Philippines, with the foreign sourced income exemptions, with generally the low cost of living, that you really wouldn't want to be taking extra liberties to kind of put yourself in a position like that. So yeah, I would always recommend in general, don't rely on lack of enforcement as a tax strategy, and specifically in a country like the Philippines, the potential downsides I think massively outweigh the kind of benefit you could get from that. So to summarise, the Philippines can be a great place from a tax perspective if you're a non-Filipino and you don't have any locally sourced income. On the business side of things, there can be some caveats and complexities that might allow you to justify this as foreign sourced. But in general, it's a little bit more difficult if you are really working a lot in the Philippines. You might still have to be careful about what you do. But yeah, hopefully this is a good introduction into the Philippines. It is a largely, I would say, still pretty unknown tax beneficial regime. And yeah, as I said earlier, I think this will probably continue to become much more popular over the coming years, because a lot of the world is really tightening up and becoming a lot less tax friendly. For the moment, don't see any signs of the Philippines changing their regime. Hopefully they do stay kind of consistent with what they're doing at the moment. But if you've got any comments or specific questions on this, just let me know in the comments section below. Cheers.